Hi, thanks for your interest in the Value Investing Bootcamp. You've made a smart decision. I'm your teacher, Nick Kraakman, founder of valuespreadsheet.com, and I hope you are as excited as I am about this very first lesson. To make sure that everyone is on the same page, we'll talk about why you should invest in the first place, why stocks are the best place to put your money, the right way to look at stocks, what value investing is, and why all the greatest investors in the world apply this highly effective strategy. We have a lot to cover, so let's get started. First of all, why should you even bother to invest? I mean, wouldn't you rather spend money on fun stuff today rather than locking up your money in a boring investment? Well, of course it is fine if you enjoy the money you earn today, but if you don't invest any of it, you will be chasing paychecks all your life and never be financially free. Instead of working for money, investing allows you to let money work for you. It is like planting a money tree, which grows bigger and bigger over time. Master investor Warren Buffett illustrated this point nicely when he said, "Someone is sitting in the shade today because someone planted the tree a long time ago. Living on a bit less today allows you to live like a king later." Besides, our social security system has some major flaws, and the predictions are that the social security system in the United States will be bankrupt by 2035. This is huge because it means you cannot rely on the government to help you out in times of need, or even when you retire. You need to take responsibility for your own financial future and that of your family. And the sooner you start, the better off you'll be. Even if you would invest only $100 each month and earn only 10% a year, which is easy to achieve with the investment strategy you'll learn in this course, this means you'll have over $218,000 in 30 years' time. So start your investing journey today. As author Karen Lamb once said, "A year from now, you will wish you had started today." In this course, you will learn the strategy which the best investors in the world use to earn mind-boggling returns on the stock market. It has literally earned them billions, and anyone can apply it, including you. So why should you invest your money in stocks and not in gold or government bonds? Well, because stocks have historically outperformed both of these with a significant margin. This is what $1 invested in 1926 looked like in 2013, if we take inflation into account. That tiny purple dot is what would have happened to your money because of inflation if you kept it in cash under your pillow. Bonds did slightly better as an investment, and an investment in gold would have grown your money decently. However, stocks outperformed gold 64-1, and this is despite the Great Depression, the Second World War, the dot-com bubble, the financial crisis, and other devastating events. So if you are serious about growing your wealth, then stocks are the way to go. There are two ways to look at stocks: the right way and the wrong way. If you look at things the wrong way, it does not matter how much effort you put in or how smart you are, because the chances of the desirable outcome remain small. Garbage in, garbage out. And since we are talking about putting your hard-earned savings on the line, we should make sure that we look at stocks the right way. So what is wrong and what is right? Well, it is wrong to look at stocks like things which fluctuate in price, because this gives the impression that price is the only thing we can rely on in our analyses. There are in fact people who use only historical price information and charts to predict short-term price movements and determine whether and when to buy a stock. This speculative game of predicting the unpredictable is called technical analysis, and I suggest you stay far away from it. Why? Because not a single technical analyst has ever made it into the Forbes 500 list of richest people, while many value investors have, because value investors look at stocks the right way, as parts of a business. Let me explain by giving you an example. Bill, a hardworking guy with a dream, starts a small one-man company selling toothpaste for cats. Business goes well, and after a few years, the company is generating several $1 million in annual income. Bill, hoping to make more cats happy, wants to expand his business internationally. This requires a significant investment. To raise the necessary funds, he decides to bring his company to the stock market. This is what happens. Bill's company is split up into 10,000 tiny pieces. Each piece is called a stock. These stocks are then offered on the stock market, where people like you and me, as well as pension funds, banks and other parties, are free to buy them. Each stock you buy buys you 1/10,000th part of Bill's business. By investing in Bill's stocks, you effectively become the owner of a small part of his business, and the fate of the money you invested is therefore closely tied to the performance of Bill's company. The more money Bill makes, the more money you make. Now that you know that a stock is essentially a part of a business, and that the performance of the business is therefore closely tied to the performance of your investments, it follows logically that to analyze the attractiveness of a stock, we should not look at the price of the stock, but instead look at how much money the business is actually making. We'll cover this process in detail in later lessons, but for now it is sufficient to know that this type of analysis is called fundamental analysis. Fundamental analysis is the right way to analyze stocks. It's like a can of tuna. You can sell it for any price you like, but this price says nothing about the quality of the tuna in the can. You won't know how good the tuna is until you actually open it and look inside. Technical analysts try to predict short-term price movements, disregarding fundamental data about the underlying company, buying stocks and then quickly selling them again for a profit. At least that's the idea. The problem is that stock prices are determined by supply and demand. If more people want to own a certain stock, the price goes up. If a lot of people want to get rid of a stock, the price declines. Sounds simple enough, but people do not act rationally. They act emotionally, especially when it comes to money. This irrational behavior on the stock market makes it absolutely impossible to predict short-term price movements. This is why technical analysis is doomed to fail. In the words of Warren Buffett, market prices are set by herds of emotional, greedy, or depressed persons who do not always act rationally. Value investors take a completely different approach. They do not try to predict short-term price movements, but instead use the irrational behavior on the stock market to their advantage by buying pieces of great companies at bargain prices and then simply wait until the price inevitably reverts back to value. To give the floor to master investor Warren Buffett once more, whether we're talking about socks or stocks, I like buying quality merchandise when it's marked down. Value investing is a contrarian strategy, because the reason why a stock is cheap is often because not many people want to own it. However, if you could buy a quality house worth $100,000 for just $50,000, you have a good deal. And even though you cannot predict what the price of the house will be in the short term, you can be fairly certain that you will make money in the long run, or at the very least minimize the risk of losing money since your purchase price is already so incredibly low. Or as the ridiculously successful fund manager Monish Pabrai once described his value investing strategy, heads I win, tails I don't lose much. $10,000 invested in Pabrai's fund in 1999 was worth $659,000 in 2006, an impressive annualized return of 28% after all fees and expenses, which is much more than the return of the stock market as a whole during that same period. Remember, this period includes the dot-com bubble. So while it is common knowledge that to earn more money, you need to take greater risks, value investing turns this notion upside down and is actually a strategy which maximizes potential gains while minimizing downside risk. Buffett said, "Risk-reward is not positively correlated for value investing." Value investing is based on the following two simple principles: finding high-quality, profitable companies and buying them at bargain prices. Both of these topics will be covered in great detail later on in the course. So if this strategy is so simple, why isn't everyone doing it? Well, because it requires patience, hard work, discipline, and the right mindset. Value investing is therefore not for everyone. Where many strategies are incoherent and resemble gambling and speculation, value investing is a proven strategy based on common sense. Benjamin Graham, a Columbia Business School professor, is the so-called father of value investing. Graham wrote the best-selling books Security Analysis and The Intelligent Investor, in which he explains the value investing framework in detail. Graham pointed out that stock prices often divert significantly from the actual fundamental value of the underlying business. He believed that buying stocks of quality businesses when they are underpriced with respect to their fundamental value allows someone to make a good return on investment at a lower risk. Graham taught all of his investment principles to his student, Warren Buffett, who then used this knowledge to amass a fortune of no less than $65 billion, making him the third richest person in the world. If you had invested $10,000 in Buffett's investment vehicle, Berkshire Hathaway, in 1965, you would today be the proud owner of more than $85 million. In comparison, the same amount invested in the S&P 500 would only be worth $500,000 today. This enormous difference in profit is the result of consistent market-beating returns earned by applying sound value investing principles in combination with the power of compounded interest, which Einstein referred to as being the eighth wonder of the world. Compounded interest is simply interest you earn on your interest, and this allows you to earn exponential returns. Let me clarify this with the following example. Investor A and B both invest $10,000. They both earn 20% per year. However, Investor A spends his profits each year, therefore earning $2,000 a year, while Investor B reinvests his profits, so he will also earn interest on his profits. This is called compounding. Let's see what happens over the course of 20 years. As you can see, Investor A would have earned $50,000 after 20 years, while Investor B, who reinvested his profits, amassed a sum of more than $380,000. This is a massive difference. This shows how powerful compounded interest is. So be patient, because time is your friend on the stock market. Now let's add another investor, Investor C, who also invested $10,000. But earned 21% instead of 20%. As you can see, even though he only earns 1% more per year, his total profit after 20 years is $65,000 higher than that of Investor B. This is why every penny counts and why you should minimize costs, like transaction costs, wherever possible. It simply adds up over time. To summarize, investing in stocks yields the highest possible returns. Stocks are part of a business and not things that fluctuate in price. Value investing is about buying great companies at discount prices. Value investing is a low-risk, high-reward strategy. Value investing is a long-term strategy. Benjamin Graham is the father of value investing and Buffett's mentor. Stock prices can divert significantly from underlying business values. Compounded interest is the key to exponential returns. In the next lesson, we'll talk about why you are probably better off investing your own money rather than letting a broker handle it for you. I'll see you there.